So I think this recent dip that we had was the vol crush that we're looking for. I think volatility was just staying so elevated this entire time until we finally got that blowout. And now that we're nearing all time highs, like the VIX is just getting crushed. We got down to 12 today on the VIX. And I think SVIX, this might be what SVIX needed to really break out and just continue that run that we're looking for.
Yeah, so you're right. Yeah, like honestly, this vol environment was pretty aggressive that we were experiencing going into the recent rip up to the 20s, and now we're obviously back down in the 12s. But that chopping back and forth action was pretty annoying for anyone running basically short vol, right? Because it wasn't it wasn't so much the spot, but even if you look at the futures, right, you were getting this weak degradation. Like typically we get this smooth glide down in short vol, and this weak degradation prevented you from really picking up that negative carry that's associated with the short vol trade. And I think that I mean we're starting to see that come back now. I think that there's a possibility that um, going into next week, obviously, right, we have CPI, so maybe there's some volatility around that. But I think that as long as vol kind of corrects itself here and
I
straightens
wonder if
itself out.
there is some sort of relevance in terms of how far the market gets away from Momo. So, like, during that whole period there where volatility was
on
remaining elevated,
on Q's or
yeah,
bit. You're talking about
Nasdaq and
oh
and
yeah yeah
even
yeah
even
yeah.
the S&P, like we were
Oh
just getting
yeah.
so stretched, and I think the market was just kind of picking up like, okay, like this is not a sustainable path. There is going to be a pullback. And I think that's why VIX was remaining elevated throughout that time. And then now that we got that pullback, we've closed that gap towards Momo and kind of just towards that the mean, like the mean reversion theory. As you get away from that mean, you're kind of expected to go back to it. And now we did. So I think that's what VIX was looking for to really get that vol crush now.
Right, yeah, and I think that is actually a good take to look at it, right? Because honestly, it was like new all-time highs back to back to back, and that continued for a while to say like, oh, after a certain time you're bound to roll over. I mean, we're pretty much back to where we were now on the Nasdaq, going into the whole Israel conflict. All those headlines started emerging, right? Where we've pretty much erased all that entire decline. So I think going into this whole uh, pullback, washout, whatever you want to call it, you're right. It was pretty evident that if the market was going to roll, we were in such a tight range that if the market was going to roll, and obviously with VIX, right, we are pinging between 15 and 12. If the market was going to roll, there was going to be some sort of snapback. So and every time the market dumped, puts were being hedged up real quick. We kept talking about that going, if we go back in our timeline on X, it was a very prominent issue that we were seeing where people were just acquiring puts very quickly and the market couldn't really dump. And it took some geopolitical headline to really unwind that issue, right? And now we've kind of reset it. And yeah, I do agree with you that if markets can hold up and grind here, I think we can get back to that continual negative carry on the short vol trade, which should benefit our short vol
Yeah, and
positioning.
it's
Now,
just a cycle, right? So we're gonna now we kind of reverted back to the mean, and VIX is allowed to get crushed now, and eventually we're gonna start deviating once again, and probably hit that same situation where VIX stays elevated as people are hedging up and expecting another pullback. But I
yeah,
think this was the pullback. I think it's safe to say, I mean, anything is possible, obviously, but I think it's pretty safe to say that that was the pullback. We'll have to see how CPI comes in next week. Who knows? Maybe that's really what the market is waiting for to hit new all time highs. We've kind of been stagnant here for the last few days, likely just waiting for that CPI number.
yeah, I do think that if the market does pull back on the CPI print, and obviously, I think we'd have to see some real significant update to CPI expectation or inflation expectations overall to spook the market, right? Because I mean, even if the print is hot, and nowadays when the prints being hot are what, 10 basis points, right? 5 basis points. Um, I think that's not hot enough at this point. I mean, from where we are, I think we need to see a real significant shift. Um, at least in forward inflation expectations as well over the next couple of months. They need to really lift too. So even if it's moderately warm this print, I don't know. I don't know if the market may dip obviously on the print initially, but I think that's going to be a headline driver, and then the macro trend will of positive growth and inflation will pick up the slack if it need be, as it did here in the recent dip.
Yeah,
And
and
I think
overall the landscape is looking pretty good now. So during that dip, there was a bit of a scare of, we went from 6 rate cuts down to one, and now we're back up to 2 rate cuts priced in for the year. And what do you think that we're still going to get 3 rate cuts as the dot plot is saying?
I think we have to keep that as the base case until that changes, right? Trying to front run the dot plot changes are kind of hard because I think the Fed can very well deliver 3 rate cuts this year. Inflation has moderated quite a bit since obviously peaking at close to 10%. And I think in the range that we're in, you have to understand that it's not so much where inflation is today, but it's where it's going to go going forward, right? So like if we look at something like commodities, right? So just a commodity basket, we're not above the 2023 highs in commodities, which means energy, etc. in the CPI basket will become a tailwind for disinflation at some point over the next 3 to 6 months, because this is not accelerating enough to really carry inflation higher from here. Obviously, we know services are sticky, right? Rents and stuff like that. But energy isn't really, commodities aren't really accelerating. And then you have the slowdown in overall demand, not demand. I don't want to say demand, but you have this slowdown in desire, I should say, to believe that inflation is going to be out of control. So I want to elaborate more on that. The longer inflation doesn't put in that second wave that everyone's talking about, the less likely it is to happen, right? Because to a degree, inflation is driven largely by expectations, right? So if people are expecting another wave, you can create a second inflation wave. Even it might not be as strong, right, as the supply driven inflation or whatnot, or supply shocks and money supply driven, etc. Right, but like the fear of inflation can keep people raising prices, can keep prices higher for longer, etc. Right, so like it's something that I think the longer inflation doesn't move, the more confidence is being instilled that inflation won't really rip up again. Maybe it chops around as we've been saying for the last year, what, a year and a half now. It's easy to get inflation from 9 to 5, and very hard for it to get from 5 to 2. So I think that's where we are right now. We're in that 5 to 2 range, and as long as we chop in there, the Fed's above the level of restrictiveness that's required. I would consider it at this point. I would qualify at this point that we're somewhat overly restrictive, and rate cuts do need to start coming in to answer your question. I do think 2 to 3 rate cuts is 3 rate cuts could happen. 2 rate cuts could happen. I think the real problem here is getting the ball rolling, because everyone knows once the Fed starts their policy cutting path, like a decision's been made to make policy easier, right? Like we got the decision at the last meeting with the balance sheet runoff reductions, but that really isn't what I think the market is so focused on. Tapering QT is helpful to a degree, but it's not as helpful as the market really loosening up on the longer end in terms of policy expectations and becoming more dovish and just loosening up again, rate differentials and currencies and whatnot. So I think as long as we can keep inflation in check, which again, you're going to have this
Well, the
you're
the
not going
main
to.
the main contributor to inflation is core services right now. And what really needs to happen for that to also come down, like we've seen with energy, food prices? Why is core services staying elevated, and what needs to happen to pull that back?
Well, I think there's this understanding that, or this belief that people look at all the inflation components equally, right? So they look at energy, they look at food, they look at goods, and they'll look at services as the main categories. And they'll say, okay, energy is volatile, right? And food's volatile, and they either want to eliminate those two baskets and isolate goods and services, aka core, right? Or they want to discredit the fact of how volatile those are and really just focus on one of them, right? If it may be services or it might be goods. They want to go even further in isolation. I should say discredit. I should say discredit
Yeah, but
most of them,
to come
right?
back to 2% CPI, we need to see core services come down, like we've seen with energy. Like it's easy to monitor energy. We just look at oil. But for core services, what needs to happen for that to come down?
Well, a big component of services is going to be shelter, right? And shelter is just rents, and we know that rents in the CPI, the way the BLS measures rents lags the market rate by about 6 to 12 months,
Well,
ballpark.
isn't rent also affected by the rates? So if people's mortgages are higher, they're going to rent out their basement suites for more, or if they have rental properties, they're going to rent it out for more to make up for these higher rates and be able to basically pay off their mortgage.
Sure, but we're measuring on a rate of change basis, right, in the CPI basket. So yes, there was that shock in 2022, right? But so 2023, but it's also a stickier thing. It's very meaning, okay, so I guess what you're asking, and I'm going to deliver my answer to this in a different format. Energy prices can fall drastically. It's unlikely for rents to fall drastically, right?
Yeah.
So that's where the stickiness, and that's why the stickiness in services comes from. It's not just shelter; it's other things too, right? It's anything really with a contractual agreement to continue providing a service. That's where the stickiness emerges from, right? So I think you have to take a step back and look at it like this. Core itself, core inflation is a very sticky thing. It's a very lagging indicator. It's not something that's going to react real time. Meaning we've seen recessions and economic slowdowns where inflation has come down, or just in periods of lower inflation where core it's been somewhat elevated. Now people like to isolate core because it supports their narrative depending on what's going on. So for example, when inflation's falling very aggressively, people like to point at, oh look, headlines down real bad, bonds are up. Great. It's headlines show when inflation's falling. But when inflation's going up, no, headline is irrelevant now. We have to focus on core. And this is the game that's being played. And that's why people pivot so much from core to headline. And I think you just have to focus on headline inflation because again, you can't discount food and energy prices, even though they have a smaller weighting in the basket, right? Because services, shelter, etc., are more important to a degree, right? Whatever. But we can look at the whole view, inflation as a whole. Services are going to remain sticky for some time, but we know that there's some slowdown to come from that. On top of that, we know that the energy sector is going to have, it was a tailwind for disinflation in the late part of 2023. And then it flipped pretty much here, right? Late part of 2023, it was a tailwind and then it rolled up and then it was a tailwind again. But now it's pretty much teetered on in terms of being significant and insignificant, right? It hasn't really done much to inflation, but it hasn't really helped pull us down in terms of negative negative contribution. And I think that energy itself will see become more of a negative contribution if prices really stay where they are right now, or at least be net neutral with services coming down. That should help the overall inflation fight. And then we obviously know that consumption on the government level is still running strong, and I think that's going to really help kind of burn off some of these inflation fears, right? So I think it's very important to cover the fact that look, inflation at 3 or 4% in the grand macro scheme of things is not a problem. For the Fed, it's a problem because their target is 2%, right? But if you have real growth, a real consumption printing 2% plus every quarter, as long as that happens, and as long as inflation continues to moderate lower, it's one hand washes the other.
Yeah, well
It's if you get
that's the
this,
key word is as long as that happens. As long as
I
growth
know.
is able to remain as strong as it is, which we did see the Atlanta Fed GDP numbers come out What was it? 4.2%?
Well, call it plus 4%,
Yeah,
right?
plus
But we know
4%.
we know we're still early, right? We're still early. That can come down. That can get revised, and we know that the official prints can miss that print. But long story short, the overall growth numbers are not weak, right? But we also know that real growth or real consumption doesn't fuel inflation. Meaning, just because growth is strong or real consumption is strong doesn't mean inflation has to be strong too. So I think there's an understanding there that if consumption is real consumption is strong and inflation is continuing to moderate, and I'm not, when I say moderate, I mean even if we chop around in a 100 basis point range from here, um, preferably under 4%, right? But like if we're just chopping sideways, it's not that much of an issue because the understanding is, look, we have money supply growth rates are went negative for the pretty much the first time since the 70s, right? And we're creeping back up just to barely positive right now. We're nowhere near where everyone claims the second inflation wave that is supposed to come, because inflation waves come in two, right? They're pointing to 1980 to the 1980 era, and when you look back, what happened in that period where inflation got that second leg up and blew past the prior highs is the Fed folded on their policy actions way too quickly. Way too quickly. I mean, we're talking right now, the Fed has already been sideways longer than in 1980, late 70s, we literally pumped policy up and pulled it down just as fast.
Yeah.
Now it's a completely different situation, and also money supply has been contracting. Year over year we're printing negative figures. We did not even see that. We were still printing a high. I think it was north of 4 or 5% at the lows in the 1970s/80s. So I think there's just this money supply dynamic that's different. You have a Fed that's committed to an inflation target. In the 1980s, there was no inflation target, not to the degree there is today, right? So there's a lot of things that have changed, and I think that as long as growth stays resilient, because remember, if growth dies from here and this inflation is in this range of stickiness, you start falling into the actual realm of stagflation. You start edging into that territory of like, okay, rates are going to have to stay higher for longer, and growth is down, and not one feeding the other, but more so like, okay, we're going to have negative growth, negative real growth, and it's not going to
Yeah.
be
Well,
it's
I
not going to be
think
fun.
I think a much more likely scenario as opposed to stagflation is actually deflation, where the Fed remains restrictive, and this goes back to our compound landing, where the Fed remains restrictive for way too long, and they still haven't even cut. Like one cut doesn't mean they're making the same mistake as the 1980s, where they basically cut to zero. They didn't cut to zero back then, but they reversed their entire hiking cycle right after they saw inflation pull back. If the Fed does cut one cut at a time, that's not the same thing, and there's still that risk of being overly restrictive for too long, even if they toss in a few rate cuts over the next couple of years. But if it's not fast enough and growth starts to die, because it does happen quick. Like we got the recent jobs numbers this week, and unemployment did rise. Obviously, not a concerning amount because the market would have crashed if it was a concerning amount. But it does happen quick. So we just need to see, can the Fed get ahead of that, or are they going to go the same route that they typically go and wait for inflation to go down to 2% and then start cutting when it's going to be too late at that point and we head into a deflationary environment. And it actually seems like bonds are kind of setting up for a possible deflationary setup. We're just below Momo, and going bullish trend on bonds, that's definitely one step towards a possible deflationary environment.
This has been a trade that has gotten everyone's hearts and broken it many times over the last 2 years, right?
Yeah.
This whole
I,
bond, this
I
whole bond
remember
action.
I remember we thought the bond trade was going to be here. But then our system flipped and actually decided it was a risk on environment at the start of, when even was that? That was a while ago. I remember it was during FOMC, and we thought the bond trade was coming, but turns out the system thought otherwise, and it was right. So we
Yeah,
just got to
yeah, I
follow the
know.
system.
And everyone's looking for the bond trade because I think everyone's feeling like they're owed a rate cutting cycle, right? Because we know the Fed's to some degree. I think everyone understands unless you're really just an inflationista. We understand the Fed is in a restrictive environment, in a restrictive policy stance at the moment. So everyone has this idea that look, okay, rates are going to come down, and the bond trade's the easy trade. Rates come down, bonds go up, easy, right? Even if you get a recession, so it doesn't matter if rates come down if if the economy is still healthy, the bond trade should still actually produce some returns. So it's kind of like an asymmetrical bet, right? Like you're just betting on rate cuts. It doesn't matter if the economy is up or down. And I think that has gotten a lot of people to say like, look, I can get my coupons and I can make some appreciation here on any type of rate cut move or any type of policy move from the Fed, which we know they're going to have to start cutting at some point. And that's baited a lot of people in and out of this bond trade for months. I mean, going back to 2022, 2023 and was a beater, but 2022 was also just. I remember us in 2022. Everyone's looking to nail the lows in bonds, and if you look at TLT on a total return basis, we are pretty much just off the 2022 lows. So if you bought bonds in the stone cold 2022 lows, you'd be up. I think. I mean, we could do some quick math. You'd be up what? 3%. Pretty poor returns, right? So like I think the key here is waiting for that trigger. Like you said, look, if the first step is going to be getting back to a bullish trend, that's a start. And then we need the regime alignments and whatnot. And then we take advantage of that as that pivot happens, and we try and ride the bond wave for as long as possible.
I think
But
a situation that would actually mess a lot of people up is the Fed starting their rate cut cycle, only doing one cut, I don't know, maybe every second meeting. And
I think we should have already done that though.
people
We
might
should already,
think, oh, 100%, I think they should
yeah.
have done that already. But they will start that this year. I think that's pretty much a given. They're going to start that this year. And I think what would mess people up is thinking that that is the signal for the bond trade, where
Yeah.
bonds would actually be a profitable trade, but nowhere near as profitable as stocks. And
Correct,
so
because you
people
don't
would,
get that economic slowdown, and what ends up happening is the rates aren't coming down. You're going to get this continued jawboning and forward expectations, where like the market tries to price in these rate cuts. You know, the market will probably start pricing in aggressively, thinking the Fed's going to continue on some linear path that in your case that you're explaining they would not, and you would just get this up move in bonds, this pullback, and it would just be a horrible environment to sit through. But yeah, I agree. Like that's certainly a risk that I think nobody is really accounting for. Everyone's trying to jump on the bond trade and not account so much for that. And then speaking of like just the Fed, right? I wanted to cover the what we were speaking about earlier, like real growth, like real consumption growth in the states is quite strong. It's stronger than all these other, stronger than the Eurozone, UK, and Japan, right? So we're obviously beating out all these other countries in terms of real consumption. And what you'll see here is that the UK, for example, they had their BOE meeting today, um, and you'll see that they're pretty much flatlining now, and they're bringing up in these meetings, they're basically saying that they may have to reduce policy more than they expect. They need to cut rates. Like they're basically insinuating that look, policy is too restrictive at the moment, and they rightfully so. I mean, they flatlined growth down to pretty much zero, and they're trying to run the playbook based on the Fed. Right? They look at the Fed. Everyone, the entire world outside of our friends in Japan, are looking at the Fed and saying, I don't want to be the one to make the first move and have it be the wrong move.
yeah.
And no one will openly tell you this, right?
I
It's
could
not going to be an
definitely
open.
see that happening in Canada as well. So I'm in Canada. Our economy is not as strong as America right now, but they're definitely waiting for the Fed as well. They should have cut. I mean, we think the Fed is late on cuts, but Canada is way more late on their cuts. I mean, inflation came in lower, under control much sooner than it did in America, and they still haven't cut.
That's a good point. Like we've been claiming that the Fed is becoming later or are going to end up being later and later to the party for these rate cuts in America, right? So if the entire world is weaker, as we can see here, and they're following the Fed's playbook, and when I say the entire world, obviously on my chart here we have the Eurozone and the UK, but obviously Canada is another constituent here. But if they're all following the Fed's playbook to a degree, then they're way behind the ball. So now the risk of an multiple foreign recessions rises as these other players play overly hawkish in a game that they're basically using the NFL playbook on the MLB game, right? Like they don't have the same economy, they don't have the same workforce, they don't have the same monetary dynamic, and they're ending up running these different playbooks, and like you have to take that into account, right? So again, eurozone quite good and growth wise 1.14%. That's like half, that's less than half of what we're doing in America. So
Yeah.
even them,
And so if
they,
all these other major economies mess up and they end up dropping into a deflationary environment while America still isn't, is that something that's going to pull America into a deflationary environment?
it, it very well could. I mean, America is not immune to the problems of the world, right? A lot of people like to believe that, but it's not. Um, I would argue that America's problems I would argue that the rest of the world is less immune to America's problems than America is to the rest of the world's problems. For example, the GFC, right? That was felt globally, even though it was fundamentally in America, right? So like,
Yeah.
there's things that happen in America that bleed a lot more over across the globe than what happens overseas. But I do think that yes, if we have a bunch of other countries going into recession, in the case that they can't correct their monetary policy quick enough, it will negatively affect America. And this goes back to what we're saying, what we're seeing. Just example with the BOE, they're sitting here saying that can't they have to reduce policy likely further more than what they've previously expected for a good reason. I mean, look, out of these four countries here, they're bottom of the barrel right next to Japan. So it's like it's not like they're okay. They're at least the eurozone's running a plus a one over 100%, 100 basis point real PCE growth here, but like they're not. And the question is like, you're so close to zero, all it takes is one little scrape, and now what? And then we can always play the counter side, right? Like maybe this is their slowdown that they should be cutting into. And if they really mess this up, this is where you kind of get like the icing on the cake into just a real bad situation. But we don't want to go too far ahead in terms of the future, right? Because the beauty about what we do at Market Radar that I think gives us and not really, it doesn't, we're not the best macro research service out there, right? Because obviously everyone has their faults, no one's perfect. But I think our uniqueness that we bring to the table is that we can come to the situation with very little emotion. So a lot of these macro services provide phenomenal viewpoints in terms of isolating macro scenarios that you can profit on, and they're very thematic, right? So you can take advantage of this because of this, but they end up being very emotionally attached to these plays. So, for example, if they're betting on policy action and the data's coming out and the data's countering that policy action, they start moving into the data is fake, the data is not representing reality. You get into this whole scheme of manipulating your own thesis beyond nonsense because you just don't want to throw the towel in because you actually believe you wholeheartedly believe in what you're doing, and there's nothing wrong with that because a lot of people make a lot of money in certain trades doing it that way. I think what we bring to the table, it's a little bit different, is it's a very data centric approach and it's very emotionless, right? We have a model, a system that runs calculations on a bunch of data. It's fed on a daily basis, spits out results, and we look at those results and then we form our macro narrative. And that macro narrative is defined and basically linked to the output of those results. So the second those results change, we don't say, oh, but this, but that. No, our macro narrative, it's going to have to change. And a lot of people will not like that when we end up eventually going bearish. We will not be bullish equities forever. For now, you guys know our stance, but there will be a point where we won't be. And you have to understand that it's not we don't decide when that happens. It just happens based on the data, and we just follow the data. And we emulate our data readings off of what we have through our quant deck to you guys, so you guys can see on a daily basis what we're seeing and how we're building our macro thesis. And you can take that data how you will and build your own thesis. If you think for a certain reason this sector or this region is going to perform very well because of these outputs, that's on you. You can design that and you can build that on your own time. The quant deck is designed to be a finalized and high polished data output deck that is not just lines, or it's not just formulas. It's not just boxes of Excel data, or output data, right? It's just simplified data from our models that are refined, so you can take that simplified data and mold it however you see fit. But I think that's where we're going to wrap it up this week, guys. Thank you so much for listening. If you like this podcast, please like, share, and send it to your friends. You can find us on Twitter at The Market Radar, or on our website at market-radar.com.